All right, let's get into it. Today, we're focusing on what is, without a doubt, the single most important skill for any trader's survival: position sizing. This has nothing to do with predicting the market. It's about controlling the one and only variable that you truly can: your own capital.
First things first, you have to accept a core truth of this business. You cannot control where the price is going to go. No amount of research, no fancy chart, no gut feeling can actually influence the market's direction. You have to let go of that idea. Your lack of control is the starting point for building a process that actually works.
So once you stop fighting that battle you can't win, you can pivot your focus to the one thing you have absolute 100% authority over: how much you stand to lose. This is where you shift from being a market predictor to being a risk manager, and that makes all the difference. Okay, so let's build the foundation. We're going to establish some fixed capital rules, and let me be clear, these are not suggestions or guidelines. They are non-negotiable. First, we establish our total capital. For this entire system, we are locking it in at 10,000 rupees. This number doesn't change if you have a good week or a bad week. It's fixed. It's the bedrock for every single calculation that follows. And from that fixed capital, your maximum risk on any single trade is also locked in at 1%. Not 1.5% because you have a really good feeling about a setup. Not 2% because you're trying to make back a loss. It is always 1%, period. The math here is really simple, right? 1% of 10,000 rupees is 100 rupees. This is it. This is your line in the sand. It's the absolute maximum amount of money you are allowed to lose on any single trade. This number becomes your primary defense against blowing up your account. And this is the most critical point of all. That 100 rupee limit dictates your actions, not the other way around. If a trade setup requires you to risk more than 100 rupees to be valid, the setup's quality is completely irrelevant. For you, in your system, that trade simply does not exist. You walk away. So how do we enforce these rules without letting our emotions get in the way? We use a simple mechanical tool. We use a formula that takes all the guesswork and all the "I feel like" out of the process. And here it is. This is the formula. Your quantity is simply your maximum loss, that's our 100 rupees, divided by the distance between where you get in and where you get out if you're wrong. That's it. You run this calculation for every single trade, no exceptions. Now, the formula itself has some very strict parameters. You always round the final quantity down. Be conservative. If the number you get is less than 1, the trade is automatically rejected. No discussion. We're not dealing with partial shares, and absolutely no leverage, because that just artificially messes with your risk calculation.
All right, let's see how this works in practice. This isn't theoretical. It creates a very clear yes or no decision. We're going to look at 2 quick scenarios.
So in this first example, your entry price is 250. Your stop loss is at 245. That means your risk per share is 5 rupees. You take your max loss of 100 rupees, you divide it by 5, and you get a quantity of 20 shares. The math checks out. The trade is valid. You get the green light. Okay, now look at this scenario. This is a higher price stock, and you need a wider stop. The risk per share is 150 rupees. So you take your 100 rupee maximum loss and divide it by 150. What do you get? 0.66. Since that quantity is less than 1, the system forces you to reject it. There's no room for negotiation. The trade is off the table. And this leads us to what is arguably the most critical skill this whole system helps you develop: the discipline to say no. It's about rejecting trades based on cold, hard math, not your subjective opinion of how great the setup looks. This right here, this is the internal conflict every trader faces. The emotional trader tries to bend the rules to fit what they want to happen. They bargain, but the system trader just states the mathematical fact and moves on to the next opportunity. Your entire goal is to silence that emotional voice and operate only with that mechanical logic. To stay disciplined, you have to know where the traps are. You have to recognize the common ways people fail. Because believe me, the temptation to break from the system, especially when you're starting out, is going to be incredibly strong. Let's be crystal clear about this. These are not mistakes, they are violations. If you move your stop loss just to make the position size bigger, you've completely invalidated your risk calculation. If you risk more than 100 rupees on a so-called sure thing, you're not trading, you're gambling. And if you ignore the formula because of a gut feeling, well, you've abandoned the process entirely. Any one of these breaks the system. So what's the big takeaway here? The goal isn't to be right on any single trade. The goal is to be systematic, every single time. This mechanical process is designed specifically to protect you from your own worst enemies: the fear that makes you sell too early, the greed that makes you hold too long, and the overconfidence that leads to catastrophic mistakes. At the end of the day, it all comes down to this one simple, powerful principle. The math isn't a suggestion, it's the final judge. And yeah, will this rule mean you'll miss out on some trades that would have worked? Yes, it will. But will it absolutely guarantee your survival in the market while you develop a real edge? Without a doubt.